Oh, Adrian, you got all dressed up? I thought everybody would be casual.
All right, guys, I'm taking us live. Filters on.
Is this thing hidden, Paul?
You can never tell if it's not in the center.
Okay.
All righty, ladies and gentlemen, we are just getting started, and momentarily we'll be introducing our panelists for our final panel of the Money, Metal, and Mining Virtual Expo, closing out day one.
Oh, shoot. Paul, did you guys hear that noise?
We can, Peter.
Paul, can you mute my computer? Shoot, I left it on behind that curtain. Shoot.
All righty. Panelists, can you hear me okay?
Yes.
Yep.
Yes.
Excellent. Cameras are on. I want to welcome each of our panelists to our final session today. Adrian, if it's okay with you, I will do the introduction for each of the panelists, unless you would prefer an introduction for yourself, and then have each of the panelists do themselves.
Well, whatever you want. I've got an introduction, but however you want to handle it.
Excellent. Why don't I introduce you, and then I'll let you take it over from there, and then I think the panelists can talk about themselves as well. Excellent. Alrighty, well, welcome everyone. We're delighted to welcome you to our final session today. The topic will be where are gold, silver, and mining stocks going next? At this time, I would love to introduce our moderator for today's panel discussion, Adrian Day, who's a London School of Economics graduate and heads up Adrian Day Asset Management, specializing in global diversification and resource equities. Mr. Day also manages the Euro-Pacific Gold Fund. His latest book is Investing in Resources, How to Profit from the Outsized Potential and Avoid the Risks. Adrian, it's a pleasure to welcome you. The stage is yours.
Well, thank you very much, Jordan, and welcome, ladies and gentlemen. I'm going to introduce our panelists, but I'm going to introduce them very briefly because I think everybody knows everybody on this panel. So we have Brien Lundin, who's the editor of the Gold Newsletter and ringmaster of the New Orleans Investment Conference, which is going to be live this year, come hell or high water. We have Rick Rule, everybody knows him, until recently the CEO of Sprott USA, now partially unleashed to speak his mind as president of Rule Investment Media. And we have Peter Schiff, founder of Euro-Pacific Asset Management, whose suite of funds, I think, includes a gold fund. Is that right, Peter?
Yes, it does. As a matter of
Okay.
fact, nice of you to point that out.
He's the author of many books. Now, last night, I was asked to moderate Brien, Rick, and Peter, and I thought the last thing we want to do is moderate these gentlemen. I think they should just speak their minds. And where there's disagreement, let's hear the disagreement, and let's give people the best advice that we possibly can. Now, the title of this panel is Where are gold, silver, and mining stocks going next? So I'd like to sort of start, maybe, turning that a little on his head, start with Peter, if I may. You know, with all of the money printing going on, the question many people ask me is, why is gold not higher at this point?
Yeah, well, you know, pretty much whenever people ask me where I think gold mining stocks are going next, I usually say higher. But this time I really mean it. But no, I think the problem is everybody expects the Fed to wage a successful war against inflation. So people are not worried about inflation, and that's why they're not buying gold and gold stocks. Well, I think they're wrong on two counts. One, I don't think they could win a war against inflation. But two, I don't even think they're going to wage one. I think it's all bluff. I think now they're kind of hiding behind the idea that it's transitory, just kind of the way they initially dismissed subprime as being contained. Well, I don't know at what point they have to acknowledge that it's not transitory. They can probably wait for a long time, no matter how high the official numbers go. But eventually, I think the numbers will be too high for the Fed to even do anything about it, because they'll be so far behind the curve, there won't even be a point trying to catch up because of the damage that they would do with the tighter monetary policy that would be necessary to put that genie back in the bottle.
Okay. Do you think it's mostly psychological? People think the Fed's going to win, so they're not investing in gold.
And they think the Fed will be raising rates, which they assume is bearish for gold.
Right, right. Anybody else want to add anything to that particular question?
I can, Adrian. You know, I like the question. I say I like the question because I think I actually wrote that question for the Money Show in preparation for the panel. But it is a good question. That's why I came up with it. Why isn't gold going up higher? Because the fundamental story, the backdrop is so powerful. It's probably the most powerful it's been in our investing careers. You have unprecedentedly easy money policies. It's hard to imagine how they could get any easier, but I'm sure they'll come up with something. You have massive spending, fiscal spending, stimulus spending, even infrastructure bills. And I think the answer is that gold did soar in response. Gold discounted everything we're seeing now. Way back last summer, it peaked at over $2,000 an ounce in August, and it really got ahead of itself. And given that kind of powerful fundamental story for the metals, gold needed a much longer correction, a correction of this duration and this degree to wipe out that enthusiasm, to exhaust the sellers. And it didn't take that long for it to wipe out the generalists who had gotten into the sector. They left a good while ago. But it took longer to get the gold bugs discouraged. And I think that happened finally in March, in February and March. We had that double bottom. I think finally the gold bugs got as discouraged as they were going to get. They really didn't abandon their holdings. They didn't sell out in gold, but they didn't expect gold to take off anytime soon. And they had kind of quietly resigned themselves to just sit back and wait it out. And frankly, I think that kind of pessimism still holds for gold. And that's a very fertile ground for a new rally. Nobody really expects a gold to rally right now. And I think that might be precisely the reason why it might do that.
Yeah, that's very good points. And I would also say, you know, I think a lot of times people expect too much from gold. You know, gold is not meant to be Bitcoin or Tesla or anything else. It's meant to be a store of value. It's meant to hold purchasing power. And if you think back to the beginning of last year, gold was at 1517. That's an auspicious date, isn't it, for religious historians? You know, it's up $260. I mean, there's nothing wrong with that, as it were. So, Rick, do you want to add something, or shall we move on?
No, I don't. I think you've done a good job. Thank you.
Okay. I've got a question for you in a second, Rick, but I was also going to ask Brien to start on this one. So what do you think will be the catalyst that will, you know, change people's minds, change sentiment, make gold go up?
Well, the bond market, frankly, there's a scenario that I was not so much predicting, but hoping for, that we would get these inflation numbers coming out, and that the bond market, you know, as smart as it is, may have already discounted higher inflation and would not react. We would not get a rise in bond yields, particularly the 10-year yield. And that's kind of playing out right now. The 10-year yield is actually falling, even though we're getting these you know, really hot inflation numbers coming out. And I think that could prompt investors to slowly return to gold. I don't know that gold needs much of a real instigation right now at this point, a precipitating factor, as much as it just needs the selling to abate. And I think that's happened. I think we've gotten that selling pressure abating. And, you know, even if we grind sideways for a while, that's not that bad, as you say.
Do you want to add anything on that?
Talking to me.
Or Rick? Either one.
Again, I would suggest that if there is a catalyst that surprises people in the near term, it would be as the impact of higher interest rates on the U.S. 10-year Treasury begin to work themselves through other parts of the economy, and other parts of the economy are either unwilling or unable to sustain higher interest rates. As an example, you're starting to see a slowdown in the quantity of brokered deposits in savings institutions as a consequence of higher US 10-year treasuries. If that blows up interest rates in other parts of the economy falters, I think you'd see the Fed lower interest rates pretty quickly. And if that happens, I think you'd see a real response in the gold price.
Yeah,
I
because
mean, a response to
basically,
the upside.
yeah, what they end up doing is throwing gasoline on the fire, because one of the reasons that interest rates may be rising, particularly long-term rates, is because bondholders are building in a larger inflation premium as they look at these endless deficits and the monetization to finance them. And once the government or the Fed perceives that interest rates have risen to the point that it's really hurting the bubble economy that they've inflated, if it's hurting the housing market, if it's hurting the stock market, the ability of people to borrow, to consume, if it's impeding on the government's ability to finance its debts, then the Fed is going to be motivated to step up its QE program and move into the market and buy more U.S. Treasuries or any other interest-bearing instrument that it wishes to suppress. And the only way it can do that is to print even more money than they're already printing. Well, if bond investors are already spooked by inflation, and then the Fed's answer to that is to create even more inflation, that's when it spirals out of control. And yes, the price of gold should go ballistic at that point.
Here's one for you, Rick. When we get a new account if we get new accounts over the last couple of months, I've felt a little bit like a kid in a candy store. The royalties are down, the big miners are down, the exploration stocks are great, even bullion's doing it. So where do you think the best value is now? Where do you think the best opportunities? Maybe that's a better way of putting it. What sector of the market?
But with the caveat that there isn't any one size fits all answer. It really depends on the individual investor's aspirations. The places that I'm seeing the best opportunity is in the mid-cap gold stocks, particularly the single asset producers. There's always a premium on multi-asset producers because they're rightly perceived as safer, having multiple sources of income rather than one. But the gap between the very large cap producers, the multi-asset producers, and the single asset producers is the broadest that I've seen in my career. Similarly, the enterprise value relative to net asset value of single asset producers at the forward strip price, not assuming vastly higher gold prices, is the cheapest that I've seen in 45 years in the industry. So my suspicion is that the sort of mid-cap 600,000 ounce to million ounce producers, in particular single asset producers, has the best risk to reward juxtaposition in the space. That may be too sophisticated for some investors. Often, Adrian, you and I have had this discussion in the past. After 45 years in the space, part of me says that in a gold equities bull market, just capturing the market beta, not trying to outperform the market and generate alpha, is smart, given that trough to peak gold equities bull markets often generate 500, 600%, 700% returns. Let's say that you de-risked the beta by buying the 5 or 6 best companies in the space, the Francos, the Wheatons, the Agnicos, the Barricks, and you only generated 475% returns as opposed to 525% returns, and you slept nights and stay calm. Would that be okay? In my declining years, I think yes.
No, absolutely. I agree with you. You're talking about single asset producers, and presumably part of your thesis, or I'm putting words in your mouth, part of your thesis is that they're more likely to be acquired. Is that right?
One of two things happens. Either the delta between the single asset producers and the multi-asset producers goes away, or the multi-asset producers take over the single asset producers and eliminate the delta in one fell swoop. It's sort of like the old Purelator oil filter commercial, Adrian. You can pay me now or you can pay me later. Either the price goes up or they get taken over. Both are good.
Right. Brien, how about you? I mean, how inexpensive do you think gold stocks are right now?
Really inexpensive. They're making money, and I'm not the first one to say this, making money hand over fist. They've got a lot of coins jingling around in their collective pockets right now. What I'm hoping for at some point is that the M&A game will start up as a result of that, and they'll start buying some of these, not just single asset producers, but even go further down the food chain into those junior exploration and development companies that we kind of specialize in. I think that could unleash or the dam could kind of break at that point, because they haven't done an awful lot of it yet in this market. And if we got some good old fashioned bidding wars for some of the better assets, that's going to raise prices, raise the valuations across the board. And as some of these companies get taken over, as we've seen before, it's going to release a lot of capital from just the right kinds of people, the people that reinvest that capital into the junior mining game. It's going to release that capital, and it's going to help lift all of the boats in the harbor, as it were.
You know, I've got a couple of questions for you in a second, Peter, but that's a good segue. You talk about releasing capital. Now, Rick, what about the opposite? What about all these private placements we've had? And lots of questions. Is it just too easy for mediocre companies to raise money? And they're obviously pulling money out of the sector. I mean, they're staying in the sector, but they're pulling money away from other companies, as opposed to what Brien was just talking about, releasing money. What are the implications, do you think, or do you agree with me? And what are the implications for both the market and for investors?
Well, I think as a group that the mid caps are undervalued. I think the juniors are overvalued. I think you could have been less polite and said that aggregations of butchers and bakers and candlestick makers who somehow get off a $20 million private placement at a $60 million pre-money valuation are taking the money away from productive uses and taking it to unproductive uses. The idea that you're seeing private placements go off with unproven management teams at premiums to market with no warrant tells me that the narrative part of the gold market, the part that's not cheap, the story part of the market, is way, way, way ahead of itself. Despite the fact that I think gold is going higher and gold equities are going higher, I haven't found a private placement to participate in that is one that I thought was worth participating in. Probably going all the way back to June. That isn't to say that there aren't some decent values in the micro cap sector, but most of those people were already financed and are fairly judicious users of capital. The ability that the great unwashed in terms of management teams have with nothing, nowhere, recycled, lousy properties to raise vast amounts of money from the dealer network astonishes me. We've joked at previous conferences, Adrian, that one of the mistakes gold bugs make is that they don't understand that the Canadian dealer network is better at inflating than the government is, issuing phony share certificates at any sign of strength in the gold market. I agree partly with Brien that if we begin to enjoy another discovery cycle, which we might with all this money raised, that those few successful efforts that emerge out of this junior carnage will sell at prices that are absolutely eye-popping. But when I look at the sort of length and breadth in the sub-billion market cap space, and in particular at the sub-300 million market cap space, I see an awful lot of unattractive, overpriced junk.
Right. And you know, one of the mistakes I think a lot of investors make is when they look at a private placement, they focus on the terms of the deal much more than they do on the actual company.
Sure. And I want both.
My rule is I never invest in a private placement unless I'll be willing to buy the company at that price right now in the market. And if I get a warrant, the warrant's a bonus to me. It's not the reason to do it. So Peter, let's turn to you. I think everyone will have something to say on silver, but let's start with you. How do you see silver? Does it have more potential than gold? And can the Reddit squeeze succeed?
Well, obviously they didn't have enough firepower to squeeze the silver shorts. Much easier in GameStop, at least temporarily. That's what they did. But I mean, we all know that silver and gold ultimately are going to participate in the same bull market. You can look at silver as just maybe gold on steroids, in that it has the potential to go up quite a bit more than gold, and also down more, and that's what we've seen. So I do not doubt that ultimately silver is going to produce a better return than gold. Now, maybe it won't be the case this time, but historically, that's what's happened to the price of silver. So my bet would be that you're going to see a bigger move in silver. I mean, why haven't we seen it yet? Again, silver has come up a lot. We remember 20 years ago when it was, what, $4? So, it's quite a bit off those lows, and we have a double top at around 50, which to me ultimately is a target that we're going to take out, and eventually that's going to be the support rather than the resistance. But, it's also possible that some of the speculative money that may have gone into silver is going into Bitcoin and some of these other cryptocurrencies. And in fact, the failure of gold and silver to have a bigger rally in the face of all this money printing and deficit spending, that's got a lot of people basically writing the obituaries for gold and silver and saying, oh, you see, the reason they're not going up is because they're no longer relevant. They're no longer stores of value because they've been supplanted by something better. And that's Bitcoin or whatever the flavor of the day is. Now it's Dogecoin that everybody seems to be piling into. But maybe, if we get some kind of a bursting of that bubble, that may, allow more focus to come onto something like silver, which is where I think some of these people might otherwise be going that weren't going into some of these cryptocurrencies.
Brien?
Yeah, I was just listening to Peter. What was the question again? Oh, silver. I'm sorry. We had started into cryptos. Yeah, silver almost invariably rises more than gold in a bull market that's based on monetary concerns, precisely the kind of bull market, multi-year bull market that I think we're in. So yes, silver is something every precious metals investor needs to be involved in because it almost assuredly will outperform gold in this bull market. Now, the silver squeeze was really not successful in affecting the COMEX or the big silver bars, the more industrial level silver demand, but mostly just on the retail end, it completely wiped out all supplies. That surge in demand made it virtually impossible to get silver, at least at anything approaching the normal pricing anywhere in the US and North America. But that is less a function of there not being that much silver out there, as it is the fact that government mints are lousy business people, which, surprise, surprise, they just don't keep up with that kind of demand. That's something that happens periodically in this market. We have some kind of a geopolitical or other factor comes in and people rush to go out to buy silver bullion and supplies are temporarily wiped out. That's what happened. Rick actually has some great insights on that with his involvement with Sprott and their physical trusts on what that kind of demand is doing on the more industrial level, the big silver bars. And I think, Rick, you had shared with me recently that it's actually getting a bit tighter, not really tough, but tighter to find those kinds of the big silver bars out there.
I would say, given the demand that we've had in the physical silver trust, we may be the largest real net buyer of silver in the world right now. And it has been, frankly, a bit of a challenge. Because we're such a big buyer, we get very good service, obviously, from the bank desks. And if anybody's going to be able to get it, we're going to be able to get it. We thought 6 weeks ago that there was only a shortage in retail denominations. But because silver is relatively cheap, that is to say, relative to its weight, it's expensive to ship. And you can cure imbalances in the 1,000-ounce gold product, as an example, by bringing stuff from Singapore or London overnight on a plane. Silver, traditionally, if you're big buyers like us, you have to truck it. And once you, if you're Sprott, clean out the available for sale silver at the Ottawa Mint, and you have to go to Toronto, that's okay. If you have to go to Chicago, that's okay too. If you have to go to New York or Boston, that's okay. But when you use up all of that product, I'm not saying that we use it all up, but when everybody uses up that product and when that product is being reminted into 1-ounce product, even buyers of our size and our type have experienced of late much more difficult markets. We've been able to satisfy those markets, but it hasn't been a cakewalk. I was really surprised at the ability of the Reddit buyer to change the dynamic throughout the silver market. I would agree with Peter that an attempt to wreck the COMEX doing that is probably fruitless, because I suspect that the people that operate the COMEX will change the rules if it ever got really, really, really tight. Suspend the silver market and then call a cash market around a price that they artificially put in place. I could see that occurring. But I think what has happened from the positive point of view from the silver market is that we've introduced a very large number of new people to the silver narrative, some of whom will drive on to the next narrative, but some of whom will stay. We've met at Sprott several thousand of them, and they're interesting young people. I welcome them to the space.
Okay. I've got two questions, if I may, before we turn it over to questions from the audience. And one question I want to ask everybody is, will you please let everybody know if you have other sessions at the Money Show, please let us know when they are. And while you're racking your brains, I'll tell you when I'm speaking. I'm on Thursday at 11:50 Eastern time. That's a talk I'm giving on gold, I think. Anyone else know when they're speaking?
I'm tomorrow morning at 9:30 a.m. Eastern time.
Okay.
9:30 to, looks like a half hour, 9:30 to 10.
I opened the show this morning as the first speaker, which is the spot I reserved for some of my closest friends at my conference, but I got it this morning.
Except for ones that speak English.
Yes.
I'm Thursday, and I believe I'm at 3 o'clock in the afternoon Eastern time. My calendar tells me I'm noon Pacific time.
Okay, good. So the last question before we open it up, we've all been in the market a long time, some of us longer than others. So what are the biggest mistakes you've made, and more particularly, what are the lessons you've learned that will be of value to the investors? So I don't mean a specific mistake, I mean in general.
I don't know if this panel is long enough to go over all mine.
I'll tell you what my biggest mistake is, and I think it's a lesson, there's a lesson for people. When markets start getting expensive, in the past, I know I would look at Franco and say, oh, that's too expensive to buy. You know, I'm not paying $80 for it because I used to buy it at $40. Oh, this one's too expensive. I used to be able to buy it at X. And I would start looking at marginal companies that were still cheap. Or put it the other way around, I would start looking at companies that were still cheap. And by their nature, 9 times out of 10, if they're still inexpensive in a bull market, they're mediocre companies. So the lesson I've learned is if you have to invest, and a manager or a fund, you have to invest. If you have to invest, compromise on price before you compromise on quality.
That's a good lesson. I would say very quickly that my biggest mistakes over time have been not selling enough. I'm a pretty good buyer. I'm not nearly as good of a seller. And in the kinds of gains, with the kinds of gains that I think we're going to see in this bull market, you'll have the opportunity to, and I think the obligation to, turn some really extraordinary capital gains. You need to turn capital gains into income. Take those profits, because they're not profits until you do. And as Rick used to tell me back in the old days, he would sell something every day on general principle. And I think that's a good lesson for anyone in these markets.
Yeah, I've ridden a lot of stocks the round trip, and yeah, it's kind of frustrating. But I know that I've always been so bullish that it's hard for me to really sell a lot. But one of the factors that has always minimized my selling has been taxes. I've been like, oh, I'm going to sell this and I'm going to pay all these taxes. So that's one of the reasons I moved to Puerto Rico. So hopefully now that I have a zero capital gains, I can be a little bit more objective when I sell something, especially since when I sell some of my gold stocks, I'm more likely to just buy stocks in other sectors, because I'm not really sure that I want to hold on to too much paper with the way they're printing it. So I just might want to have more defensive, higher yielding assets. And it would be harder to do that if, when I sold, the U.S. government was raking a big part of my capital, because I would have less to redeploy. But with zero capital gains, I don't have that problem.
I guess I'd have to plead guilty to two lessons. The first is that I have a very logical mind, and if I think something has to happen, I think it has to happen quickly. That is to say, I confuse two words in English: inevitable, which means it has to happen, with imminent, which means it has to happen quickly. And sometimes in my impatience, I've been right, but I haven't profited from it because I haven't held on to the stocks that I bought in anticipation of an event that has to happen. I think the mistake that the whole market, including myself, is making right now is to mistake two other words in English: liquidity and solvency. Everybody is comfortable right now because there's so much cash in the system, some artificial, some not. But I think we need to look at the aggregate level of indebtedness, government indebtedness, some corporate indebtedness, individual indebtedness. And we need to understand that while the system has lots of liquidity, it doesn't have anywhere near as much solvency, which makes it probably riskier than we believe it is. Gold bugs need to know too that in a liquidity squeeze, a 2008 style squeeze, everything goes down. Everything that has a bid goes down because the sell decision isn't made by the investor, it's made by the margin clerk. Gold traditionally comes back quicker because of the central response. But if you think you're going to get out of the 2008 style liquidity crisis in the near term and not have your gold, your silver, your gold stocks or your silver stocks in the immediate aftermath hit, you aren't psychologically prepared for what you might see in the next while.
But I think the problem now, Rick, is the solvency problem is so dramatic that the only recourse the government thinks they have is more liquidity to solve the insolvency. And they just inflate away the debt. But I think they're going to inflate us into a much bigger problem than insolvency if we end up with a hyperinflation or anything close to that.
No argument from me, Peter. I'm talking about between now and then. I think we have a circumstance where the markets are confusing liquidity and solvency. I even think it's a problem in the gold equities market because I think the gold juniors, the companies that are narrative driven rather than valuation driven, are stupidly overvalued. And I think that's a function of 40 years of an equity bull market and way, way, way too much cash in the system and not enough concern over solvency.
Right. Jordan, do we have any questions?
We've got dozens of questions.
Over to you.
All right. Our first question is from our viewer, and he says, to quote Mr. Rule, in resources, you're either a contrarian or you're going to be a victim. So the question is, and we'll address this to Rick first, and we'll let the other panelists take the stab at it as well. What do you consider as the most contrarian commodity currently, and which subsectors within that commodity warrant more attention?
I still believe that uranium is the most undervalued commodity in the space, with the exception of water, which basically you can't play. But in the context of this discussion, I think that precious metals and precious metal stocks represent a contrarian opportunity too, both because the fundamentals are attractive, but also because on a historic basis, precious metals and precious metals equities are almost historically underowned. A study that I read suggests that precious metals and precious metals related assets comprise 0.5% of savings and investment assets in the United States, down from a 3-decade mean of between 1.5% and 2%. So the fact that the outlook for precious metals is attractive at the same time that their market share relative to other asset classes makes them so underowned means that from a broad point of view, precious metals and precious metals related equities are also a contrarian opportunity.
Excellent. Unless any of the other panelists have another comment, I'm going to jump to our next one. Excellent. So our next viewer writes in, I read last week that China just ordered over $8 billion worth of gold after not placing monthly orders for some time. Why has this not affected the spot price? Who would like to take this one?
I guess I could take that. The spot price of gold is set on the COMEX, and it doesn't have any connection really at all with the price of gold, and similarly for silver on the street. The on the street silver spot price, for example, is about $4 higher than the listed spot price on COMEX right now if you want to buy silver as a retail investor. Sprott gets a better deal, obviously, but it's still higher than the spot price you see on COMEX, and gold as well. China is an interesting actor in the precious metals markets, particularly in gold. When you see the price of gold low, China's buying. When the price of gold is rising, China isn't buying, not necessarily selling, and you see Western investors buy. So there's flows of gold. Think of it as rivers of gold going from east to west, depending on what the price environment may be. In short, the Chinese are bargain buyers. They're long-term holders of gold, and they buy when the price is at bargain levels. I think we're going to see a shift in that. And what we're seeing right now in China is kind of the end of their buying, because I think the price is going to be rising, and they don't buy into a rising trend. They tend to cushion the price of gold on a falling trend.
Excellent.
That's true. I would also point out, if I may, that I would disagree with the premise of the question. Gold is up over $50 since the end of last week. That's not bad. I'll take that every week.
Thank you very much. Our next question is for Peter, and our viewer writes in, Peter, you've been calling for a higher gold due to Fed inflation since around 2008, but we didn't get the high inflation, and gold has been in a bear market for 10 years. In your opinion, what makes you think this time is any different?
Well, I disagree with the notion that we didn't get high inflation. We did. I defined inflation by the expansion of the money supply, which is literally where the word inflate comes. It's to expand, and prices can't be expanded. They could rise, they could fall, but they don't expand. So we had a lot of inflation in 2008, 2009, 2010, 2011. The result of that inflation initially was a rise in gold up to 1,800. The stock market went up, the real estate market went up, but then gold, silver, consumer prices, commodity prices kind of broke when the dollar began a big rise in value. Despite the fact that we had printed so many dollars, the dollar rose from near record lows against the euro and the yen and a lot of other currencies. And that really kept a lid on consumer prices, despite the fact that we were creating so much inflation. And of course, if you're simply measuring consumer prices using government indexes, you're really not measuring the degree to which prices are rising. I think prices did go up more than those indexes reveal. But there's always a lag too. When you create inflation, it doesn't immediately push up consumer prices. Sometimes it pushes up financial prices first, which is certainly what happened. But also, you have to try to figure out where would consumer prices have been but for that inflation. Maybe we would have had a decent drop in consumer prices following the 2008 financial crisis, but we didn't get that because of all the inflation that the Fed created to prevent it from happening. But I think the inflation that is being created now, and it has been created since the beginning of the pandemic, dwarfs what was done in the aftermath of the 2008 financial crisis. And the government deficit spending is a multiple. Remember, the most we ever really spent, the deficits were maybe $1 trillion a year. Now we're already more than $4 trillion a year. The balance sheet is already almost $8 trillion and headed into the stratosphere. And they're getting ready to pass another stimulus bill. The ink is barely dry on the last one. And now you have all these Americans who have left the workforce because the U.S. government has given them a much better deal, paying people more money not to work than what they used to get when they still had a job. So I think we've really upped the size of this, and I don't think it's going to be masked by a rigged CPI. And I think we're really just kind of catching up to the lag of all the money printing of the past. We haven't even begun to catch up to the money printing of the present. So I think people are going to be surprised by how much prices rise. And, the Fed is so confident that because they got away with it in the past, they can get away with it now, even though they're inflating to a much greater degree than they were then. I think they're going to be even more surprised and even more wrong about inflation being transitory and their ability to contain it than they were about subprime being contained.
Excellent response. Thank you very much, Peter. Our next question is a very popular topic, and I'll probably let each of the panelists give their opinion, but to what extent are cryptocurrencies and specifically Bitcoin affecting gold and silver in an upward pricing?
Yeah, well, I mentioned it. I think on the margin, some of the buying that might otherwise have gone into gold and silver may have been directed to crypto, but I think the bigger effect is the effect that the failure of gold and silver to have a bigger rise, how that's impacting crypto. Because I think a lot of people who are looking at the failure of gold and silver to be making a bigger move when everybody would expect that it would, that is kind of driving the narrative of Bitcoin is the new gold. Bitcoin is 2.0, and you see gold's failure to rally proves that you should be buying Bitcoin instead. So I think gold is having a bigger impact on Bitcoin and crypto than crypto is on gold. And I think one of the most bearish things that could ultimately happen for Bitcoin is a substantial rise in the price of gold that gets people to put their focus again on real gold, and that will diminish the appeal of fool's gold.
If I can jump in here from my experience, I agree with Peter 100%. I think it's very much at the margin. There have been a few high-profile investors that have said, I'm selling my gold and buying Bitcoin. We know who they are. But for most investors, I have seen no selling of gold to buy Bitcoin at all. What I have seen is people at the margin wanting to put a little bit of money into Bitcoin, but maybe perhaps would have gone into gold. And just to put that in context, so you see what I'm talking about. If I've got a client with $1 million in gold, and he says to me, I really think I should have some Bitcoin, I'm thinking of putting $10,000 in. And that's a typical comment I get. It's very much at the margin, in my view.
Excellent. Thank you very much. Our next question is, what are some indicators the panelists can use to determine the end of a currency besides the money supply? It seems that foreign exchange reserves are a good indicator. Do you think the EU, Japan, or the US will be the first to go?
Well, when it comes to the US, we don't have a big foreign currency reserve. So it would be exhausted in a day if there was a run on the dollar. I mean, supposedly we have a pretty good gold reserve, but the question is how much of it is really there, and would the U.S. government be foolish enough to dump their gold to try to prop up the dollar? I think that would be a big mistake. I mean, what they need to do is slash government spending to prop up the dollar and let interest rates go up, but it's very difficult to see that happening either. Excellent.
All right, our next question is, let's see, we only got time for about two more. Specifically to stock picks, one of our viewers, this is for Rick, you had mentioned I think it was the junior or the mid section of the gold space that you liked the best. Was there any specific stock picks you liked in there?
I'd prefer not to name names, not because I don't have my favorites, but because I'm familiar with the size of the Money Show audience, and talking to 100,000 of my closest friends precludes me from giving a one-size-fits-all answer. If I did, I would probably say to people, begin your portfolios with the highest quality companies that you possibly could. As Adrian suggests, don't sacrifice quantity to price. So be looking to names like Franco-Nevada, like Wheaton Precious, like Agnico Eagle, like Barrick. You may underperform the index a little bit, but you'll underperform it by de-risking. And for people who aren't willing to spend inordinate amounts of time, which Adrian and I do, that's probably the best strategy. It's not necessarily what I do, but it's probably what most of your audience should do.
Of course, they could buy the Euro Pacific Gold Fund and have Adrian manage their money.
I'll make one very self-serving comment, if I may, and that is, I am not a. Oh, sorry, Rick. Well, your ETF is different because you do have objective criteria. But I would caution people against just simply buying ETFs like GDX and GDXJ As I say, Rick Sprott has a ETF that does have rational criteria for selection, but most of them simply by size. And so inevitably you are buying the good with the bad and the ugly when you buy a big ETF. And that's not necessarily what you want to do. An open-end mutual fund, of course, without naming any names, is different because the manager makes selections. An investment advisor is different because they make selections.
I was going to list some of my largest personal holdings until Rick guilted me into not doing that with this massive audience. But I would say, along the lines of what Adrian just said, is if you're not going to put in the work to investigate the sector and learn about it, then you might as well just buy the indices. But you should put in the work. You should subscribe to 2, 3, or 4 of the best newsletters, go to 2, 3, or 4 of the best conferences, do the research, because particularly in the junior mining sector, it is an inefficient market, and doing more work than most other people will allow you to find opportunities that will escape most other people. And they are out there, and there are a bunch of overachievers in any bull market, and you can find them if you just devote the necessary time, money, and effort into learning about the sector and ferreting out the better opportunities. You can do extremely well in this sector.
You know, the efficient market principle certainly doesn't apply in the mining sector. And, you know, I know passive investing has gotten too popular, and I think a lot of people are going to get burned with that strategy. But I think the mining sector is probably one of the areas where doing your homework could provide the greatest degree of outperformance, because since, you know, the best and the brightest that come out of, you know, the big schools, I mean, and all the big investment houses, they don't put their brightest guys in the mining sector. You know, I mean, there's, you know, that's not where the money is. That's not where the interest is. So I think if you know something about mining and the industry like Adrian does, you have a clear advantage over people who are just throwing darts. And I think in those indexes, you have, you know, it's going to be easier for a guy like Adrian to beat that index than a lot of other managers, let's say, to beat the S&P 500, you know, where you have probably more of an efficient market, you know, playing out in that sector. And you have smarter people trying to beat that index.
Excellent.
Yeah, the smartest analysts are on the Tesla desk, I think.
Well, all the smart ones have left that desk because you can't. You have to be willing to check all your reason in order to just stay bullish on Tesla, just because the price is going up. Because all the analysts that were bearish have probably been fired. They're not covering it anymore.
Excellent. Well, gentlemen, I want to thank each of you for your time today. Before we wrap up, let's just go around really quickly, and we'll start with Adrian on just your closing thoughts on this discussion, on where you think we go next. Just real brief of what investors should be looking for.
Yeah, what I will say is, and it's been sort of alluded to by all of the speakers at different times, I truly think this is an incredible opportunity we have right now, where not only is the gold price down from, you know, August, the price is down, the outlook for gold, the environment for gold and the outlook for gold is incredibly compelling. And yet at the same time, the stocks as a broad, you know, Rick thinks some of them are overvalued, but as a broad generalization, the gold stocks and particularly the major miners are just incredibly undervalued by their own historic metrics.
Excellent. Rick, any thoughts?
I think my own belief is fairly well known. I think for the reasons that Peter has enumerated, that the gold price goes higher. I think, as Brien has suggested, in the middle and late end term in a bull market, silver moves further than gold. As Adrian has summarized, the middle part, at least, of the market caps spectrum in gold and silver is, by historic metrics, quite underpriced and probably outperforms the metal. Will this happen next week, or in fact, will it happen in 2021? I don't know. but my own experience has been that participating in a precious metals bull market is a dramatic enough event that even if you're early, you're right.
Excellent. Brien?
Yeah, the metals are one of those sectors where the near term is more uncertain than the long term. I think you have to have a good feeling. You have to be very confident that a year, 2 years, 3 years down the road, precious metals prices are going to be much higher than they are today. And therefore, good mining stocks, mining plays will be even that much higher because they will leverage those moves.
Yeah.
That said, I think right now there's not a lot of confidence. There is, in fact, pessimism, even among the most ardent gold bulls, that we're going to have any kind of a move in gold in the near term. No one's really expecting it, and I think that could be the reason why we have one. So I'm just intrigued by the possibility that no one is expecting a strong rally in gold right now, so we could have it.
Yeah, I think we're very fortunate. It may be frustrating to people, but to have the outlook for gold be so bright, yet so few investors noticing that. And in fact, having the degree of skepticism and doubt and fear that we have, despite what should be, incredible bullish fundamentals for gold. I mean, as I said, I've been bullish on gold for a long time, but the fundamentals have never been more bullish than they are now. And typically, it's difficult for markets to rally when everybody is bullish. The fact that so few people are bullish on gold, and you're right, there are a lot of people who are long-term bulls that right now are very cautious. They've kind of thrown in the towel and kind of conceded the fact that, well, it's going to be a while before gold goes up. And so we don't have all that enthusiasm. And now, the market could climb a wall of worry, which is typical of a market. And that's what you want. And, that's what we want too as asset managers. I mean, I don't want to be buying stocks that are going straight up. I mean, Adrian said he's like a kid in a candy store, and I'd much rather have people sending us money when we're getting bargains than have to be worried because the stocks are going up so much every day and we're afraid to buy them.
Excellent. Well, gentlemen, fantastic views. It's an absolute pleasure. Each one of you have been part of the Money Show for so many years, and I know our audience really appreciates every time you guys join us at these events. And I know each of you are speaking again throughout the Money Metals of Mining virtual event. So I do encourage our audience to check out the schedule, look up each one of the experts and see what time they're speaking, because I believe each one of them still have a presentation at the show. Thank you guys. Have a wonderful, well, except for Brien. Brien did an opening keynote this morning. And I want to thank you guys for joining us tonight and today. And we'll see everyone tomorrow.